Hi, this is Alan House. I'm a senior analyst here at ValueLine. I'm joined today by another senior analyst, Sharif Abdu. We here at ValueLine hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, we're going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. We will also discuss the actions ValueLine is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in our service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products of our or services we offer, or our different tiers of subscriptions, then information can be found at valueline.com, or you can call 1-800-ValueLine. Now let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Harvey Katz, ValueLine's chief economist. Like a rising number of Americans, our economy too has received a welcome shot in the arm with the recent signing of a $1.9 trillion COVID relief package by President Biden. True, this aid arrives at a time when both the industrial and consumer sectors are clearly on the mend. Still, significant pockets of weakness persist, with millions of Americans jobless or underemployed, suffering from a severe loss of income, and unable to meet rent or mortgage payments. This aid package's proponents see such shortfalls finally being addressed and sense that the business expansion soon will broaden. Indeed, the economic recovery should be hitting its stride by the second half of 2021, when GOP growth likely will surpass 5%. Such projected improvement figures to be underpinned by the financial infusions cited above, additional monetary support from the Federal Reserve, with the lead bank indicating it plans to keep interest rates at historically low levels for several years longer, pent-up demand on the consumer side, and expected progress in defeating the pandemic. Such growth is not risk-free, however, as the stimulus payments, consequent increases in the deficit, and the rush to play catch-up by millions of heretofore financially strapped Americans could well bring about a rise in inflation. That is something the economy has not had to deal with for decades. The quadrupling in Treasury note yields in the past year, albeit from a very low base, acknowledges such inflation jitters. Are these inflation threats overblown? Our sense is they are. True, soaring oil prices and the projected rise in consumer and business spending will put some pressure on pricing, But with production capacity, raw materials availability, and the labor force probably adequate to meet demand, any pricing pressure should be comparatively modest. In conclusion, Wall Street is a believer thus far. So even as Treasury yields climb, the stock market, save for a few brief and relatively modest selling episodes, remains near all-time highs on the major indexes. Just the same, the equity market's frothy levels and elevated price-to-earnings ratios suggest some caution is in order. To paraphrase Harvey, it has long been ValueLine's perspective that equities should be a core component of a well-rounded, well-diversified portfolio. In good economic times or less favorable times, in bull markets or bear markets, equity should be a core holding and investment portfolio of all stripes. To touch on some of Harvey's commentary, the economy, both in the U.S. and abroad, is still in various stages of recovery, and it might well take a while before we see a meaningful rebound across all sectors, where there also may be some hiccups along the way. On that note, ValueLine is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendation for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and subscribers. This content is posted throughout the day, again on our website, www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where Sharif is already landed. Thank you, Sharif. This is the main landing page for subscribers. Under the quick link, Sharif will click on Supplementary Reports. As you can see, the research department has been very busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. We're also monitoring our financial strength grades. Some individual companies incurred a lot of debt or sold stock to improve liquidity this past year, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Furthermore, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating dividends. Due to the changing structure of company balance sheet, ValueLine has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you who don't know, financial strength along with price stability, another proprietary ValueLine measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, ValueLine publishes a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. Okay, now we're going to move on to our intro to screener, one stock to buy right now. For this, let's go to the screener. Sharif. ValueLine subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-ValueLine. Okay, today we'll be starting the screening process by looking at growth rates, particularly over the long term. Then we'll add some shorter term metrics as well as some balance sheet considerations. I'm just going to give Sharif a second to get to the, oh, there we are. We're on the screener now. Okay, I just want, yeah, it's easier to follow. Thank you, Sharif. Okay, the first screen we're going to look at is the 5-year earnings per share growth of at least 10%. Okay, so for those of you unfamiliar, ValueLine provides estimates for both the short term, as in this year and next, as well as the 3 to 5 year investment horizon. For this screen, we are focusing on companies that are estimated to achieve 3 to 5 year earnings per share growth in excess of 10%. Now we're going to run this screen. There are roughly 5,700 stocks in our universe. And in our database, we've already narrowed it down to, Sharif, can you enlarge that just a little bit, please? We've narrowed that down to 940 results. So we've substantially narrowed our list of candidates. Okay, so we want to stay with the theme of longer-term performance. So we're going to run another screen. We're going to run 5-year sales growth of at least 10%. This is another important metric to look at because sometimes a company's earnings growth may be due to cost cutting. Now let's screen for companies with at least 10% sales growth projected over the next 3 to 5 years. So now we've narrowed our list down to 368 results. Okay, we're narrowing it down. Okay, then our next screen will be stocks ranked 1, which is highest for timeliness. If Sharif could please run that screen. Okay. Okay, now we're down to just 26 results. After running those 3 screens, we've dwindled down to just 26 results. And now we're going to do our final screen. We're going to look at companies with earnings predictability of 90 or better. This factor measures the stock's historical earnings record as it relates to our estimates. Obviously, a higher ranking is preferable and suggests that negative earning surprises are less likely. You can certainly make an argument for any of our remaining stocks. Oh, I'm sorry. What is after that? I'm sorry. We're going to see how many are left. I'm sorry. We're down to 10 results after running that screen. So we have 10 results left, as you can see. Thank you, Sharif. So now we've narrowed the list down to just 10 results. You can certainly make an argument for any of these 10 stocks. They're all solid companies. And investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend Edward Life Sciences. Ticker symbol is EW. Before Sharif clicks on Edward Life Sciences, you can also save these screens. There's a created screen. Yes, Sharif just did at the top right, I believe. It says create save screen. So if you're, looking for, saving your screen after you did it, you want to look at it later, tomorrow, whatever, you can save the screen and just call it up the next time you're on our website. Okay, so thank you, Sharif, for that. Okay, now we're going to click on Edward Life Sciences to get some additional information from ValueLine's digital report. Okay. Edward Life Sciences focuses on the development of innovative technologies that treat structural heart disease in order to improve outcomes for critically ill patients. Its primary operating division is TAVR, which is an acronym for transcatheter aortic valve replacement. This business provides 2/3 of company sales. The surgical structural heart segment generates about 20% of sales, and critical care provides 17%, and the transcatheter mitral tricuspid operations are 1%, but may offer significant growth by mid-decade as the next major innovation in the field. As you can see, as Sharif can just scroll up, in the banner section of a report, the stock now trades at $80.55. Okay, and as you can see, there's also a 3 to 5 year earnings target of 95 to 125 for that stock. That's around the center of the banner. Now we're going to look at our last full page report. Sharif, if you could just go down and click on that, please. Okay, yeah, that report was just published earlier this year. As you can see in the statistical array, or the center of the report, that includes the financial data. After a flat earnings year to the pandemic, we expect revenues and share earnings for the company to advance at a solid clip this year, thanks to the resumption of heart treatments that had been previously postponed. We look for continued improvement in the operating margin thanks to better efficiencies to produce tremendous return on capital metrics as seen at the bottom of the array. Why do we like this stock? Metrics are solid. The safety rank, as you can see, is 2. The timeliness rank actually has been moved up to 1. It was 2 at the time of this writing, but we've upgraded it to a 1. The financial strength is A, which is very solid, and the earnings predictability, as mentioned earlier, is 90. That's one of the metrics we screened for. Also, we think Edwards' position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. Okay, now Sharif and I are going to answer some questions that you have. Let me just see. There was one that was given prior to the presentation I thought was interesting, asking about the timeliness ranking system and if that's can be changed between reports. And the answer to that, as I just mentioned, as a matter of fact, is yes, it can. Edwards Life Sciences, at the time of our last report, which I believe was about a month and a half ago, was ranked 2 for timeliness, and since then it's moved up to 1. So yes, we do. Our statistics department does keep on top of this on a daily basis, and timeliness rank changes are done, like I said, just about on a daily basis and updated for each edition of our survey. And a lot of that's based on, when the company reports, if they have a good quarter, a not so good quarter, and things like that. But yes, we do, we can and do change our timeliness ranks between issues. So that's, as I was saying before at the beginning of the broadcast, it is good to check out our website regularly and to look at updates with the supplementary reports, because it is a fairly volatile market we're in right now, and it's a good idea to keep on top of things. So thank you. Sharif?
Thanks, Alan. See a good question here. Lewis Hall asked, when might ValueLine reports include electric vehicle and lithium mining company profiles? So it's funny that Mr. Hall, thank you for submitting a question. It's funny that he asked that question because we do actually cover Tesla, which is, without a doubt, the most kind of prominent electric vehicle company. The ticker symbol, is TSLA. Now, as far as kind of more green companies, ValueLine actually just came out with a new product, or it's in the process of about to launch a new product, which focuses on green companies, companies that are pushing a kind of a green initiative. That product will be launched on April 6th, and it can be found on our website. It will also be a paper product, a print product, and it will be, I believe, there will be a new issue once a month. I'm not sure if it's exactly if it's once a month or once a week. So that would answer that question. As far as the lithium mining, we don't specifically tunnel down and just cover specifically lithium mining companies, but we do cover, a whole host of different kind of mining companies in our mining industry. Alan?
Thank you, Sharif. Yeah, the next question I had relates to the the 3 to 5 year and the 18-month. As I noted earlier, there is, the timeliness rank is usually for our year ahead price performance. We also do, we have an 18-month projection and a 3 to 5 year projection. So we try to cover all fields. The 18-month is obviously for the intermediate term, and that's a fairly new statistic. I believe we introduced that, memory serves me correct, about 2 years ago, where 3 to 5 year is obviously a longer investment horizon. So we know a lot of our subscribers are have different time horizons, so we like to kind of keep all our bases covered. So thank you. Sharif?
Okay, let's see. We have a question here about the Fed's low interest rate policy. The question is there any particular, the question actually is, what effect has the Fed's low interest policy had on banking stocks? And is there any particular sector that has benefited from the Fed's low interest rate policy? So this is kind of it's a big question. This is a macro question, but I'll try to answer it with one specific example of how the Fed's low interest rate policy has affected banking stocks and financial services in general. So one of the effects that we are seeing and have seen for the past, let's say several years since the Fed instituted this accommodative policy, one thing that we've seen, one metric that we've seen really impacted, and that is the net interest margin, okay? And for those of you that aren't familiar, the net interest margin for financial services, it's basically the spread between what the borrowing costs for the banks versus the rates that they set for loans that are written. So one thing that's happened with this low interest rate environment is we're seeing margin compression. We're seeing that the net interest margin has been kind of pushed down. We're seeing margin compression, and that gives the lenders a lot less wiggle room as far as the rates that they set. Now, as far as an industry or a sector that has benefited from this low interest rate environment, I will say indirectly, companies like an industry like REITs, that's real estate investment trust, they have benefited indirectly because what has happened is interest rates are low. The bond yields on treasuries have been pushed down because there's a kind of a flight to safety. So the yields on treasuries have been pushed down. So investors that are looking to generate current income are looking for an alternative, right? And one popular alternative is REITs, real estate investment trusts, because they are very popular income vehicles. So that has benefited REITs in a way. The downside is that REIT equities, let's just say that their pricing has become a little bit, let's say, rich at the moment. They're a little bit maybe, the pricing is maybe a little bit too rich for what we would consider, reasonable at the moment. So that would be the biggest impact that we've seen so far. Alan, is there anything else that's jumping out at you?
Yes, I actually had an interesting question related to the relative PE ratio. Somebody had asked about that. It's an excellent question. What is the relative PE ratio, and how does that affect our analysis? And the relative PE ratio is simply how the P ratio of Edwards Sciences in this instance compares against the broader market. And Sharif, if you can enlarge the page just a little bit, please. as you can see, the relative PE for, oh, there we go. The relative PE for Edward Life Sciences has historically been well above the market. It's usually trades just ballpark figure 1.5 maybe to almost 2 times the market over its history. And obviously this is, a company that's in a high growth area, and it's been a star performer. So it's going to be, it's going to trade a higher P multiple than the market. So, someone even asked if it's virtually valued at present, but you have to, compare it against historical PE, so it's very important to look at that. And right now, as compared to, as when the last report was written about 6 weeks ago, it was trading at nearly 1.95 the broader market, which is a little bit towards the higher end, but it's definitely well within its ranges. It has traded at well over 2 times the market in its history. And also with being that the market's strong, so it's going to probably perform a little bit better than most companies. Of course, if it pulls back, it might be a little more susceptible to a downturn, so we might want to point that out as well. But so its relative PE is definitely a good measure to look at. I think instead of just looking at it as far as an absolute value compared to the overall market, I think it helps to compare it to its historical relative PE as well. Thank you, Sharif.
Okay, Alan, I think we're going to wrap things up for today. I just want to thank everybody for joining us. If you have any questions about any of the products or services that we offer, you can call, that is 1-800-ValueLine. You can also find a lot of the answers and examples of the products that we offer on our website. That's ValueLine.com, spelled exactly as it sounds. And thanks again for joining us today.